What's up, guys? This is Manoj Vaptani. I welcome you all on behalf of the Edupedia world. So, guys, it's a great day outside. I'm sure you are enjoying it thoroughly. We are actually living in the area which is based out on the principles of demonetization. Our respectable Prime Minister has recently announced the cancellation of the legal tender of the currency notes for rupees 1000 and rupees 500. And certainly that is creating a huge trouble for the entire economy. Many people are not in support of it because it is creating many of the troubles for the common public. But certainly, guys, believe me, all these kind of steps which are being taken by our respectable Prime Minister are in great better interest of the entire nation. So it has actually replaced out so many things nowadays. Like I've recently heard about many of the things that nowadays no more pelting of the stones are being taken care of in Jammu and Kashmir. There is because of the lack of cash currency which is not available over there, and certainly that has actually created much of the comfortable atmosphere over there in Jammu and Kashmir as well. So apart from that, Hawala money has almost came to a halt. Terrorism is no more allowed for any kind of currency generation, fake currency generation, which is being transferred from Pakistan and China into India. So that's into a great interest for the entire nation. And yes, nowadays all those stories are being heard about. That's how the economy is going on currently. It's actually having a great effect on the entire nation across the globe as well. Because nowadays, if this particular drive turns out to be a great effort, the day is actually not far when India will be able to become a superpower very soon. That's how it is going on. Perfect, guys. So, till our last presentation, we were discussing many of the topics relating to money markets. By now, we have already covered topics relating to bond valuation, capital markets, mutual funds, and basics of SFM. So now this is the second video presentation in which I'll be talking about some of the money market instruments which are available in the nation. For that matter, I'll be discussing about call money, notice money, treasury bills, certificate of deposits, interbank certificates as well. This particular presentation is solely dedicated to the money market instruments which are available in the country. So let's hop into our first topic of the day, and that will be call money and call money market. So guys, this question has been asked in CA final examination for May 2013. So what does call money mean? What's this terminology call money market actually means? So the name itself suggests, if you can easily look into it, so that says call money. So a kind of money which can be easily called upon at any point of time. So that simply states out as call money and notice money is an amount borrowed or lent on demand for a very short period. If the period is more than 1 day and up to 14 days, it is called notice money. Otherwise, the amount is known as call money. So guys, that's the basic difference between a call money and a notice money. So if the duration of the instrument is from 1 day to 14 days, the same is to be called as notice money. Whereas in any other case, the same is to be known as a call money. No collateral security is required to cover these transactions. So that's the best part of entering into any kind of money market instrument. That in case of call money, there is no requirement of collateral security. Call money participants include those who can borrow as well as lend in the market, like Reserve Bank of India, PDs, and those who can only lend, like the financial institutions, Life Insurance Corporation, Unit Trust of India, General Insurance Companies, IDBI Bank, NABARD, and ICICI. RBI has basically now framed call money market as exclusive market for banks and PDs. By PDs, I mean the primary dealers who are entitled with having these kinds of transactions. So guys, that was all about call money and call money market. So call money and notice money is the amount which is borrowed and lent on demand basically for a period of which is extremely short. If the period is more than 1 day up to 14 days, that is called notice money. Otherwise, the same amount will be called as call money. No collateral security is required in such cases, and the call money participants for RBI and primary dealers, they are the persons who can borrow as well as lend in the market. But for the other persons which are available in the market, like financial institutions, LIC, UTI, GIC, IDBI, NABARD, ICICI, they are the persons who can only lend the money but cannot borrow. RBI has actually framed up the call money market as well as for exclusive market for banks and primary dealers. So this question was asked in CA final examination for May 2013. So I wanted to include this in my presentation for that matter. So now let's move to our next topic, and that is features of call money market. So let's understand what are the features of call money market. So first of all, the call money market basically enables the banks and institutions to even out their day-to-day deficits as well as surplus of money. Commercial banks, cooperative banks and primary dealers, these are the three layers which are basically allowed to borrow and lend in the market for adjusting their cash reserve requirements. So basically that's common feature as to why call money is being introduced in the market. So they usually borrow and lend in the market just for the sake of adjusting their cash reserve requirements. Next comes, it is a completely interbank market. Hence, the non-bank entities are not allowed to access to this market. Next comes, interest rates in the call and notice money market are market determined. So it is totally depending upon the demand and supply forces in the market. So if the complete interest rates in the market are going up, so increase in the call money market price as well. However, the same is declining. So there will be a decline in the call money market for the prices itself. So it serves as an outlet for deploying funds on short-term basis to the lenders who are having steady inflows of the funds. So that's how it enables to work out in the call money market. Next, banks borrow in this money market for the various following purposes. Just to fulfill the gaps, the temporary mismatches which is available in the funds. So their first aim is to fill that gap, or I can say that temporary mismatches in the funds. Also, they have to meet the CRR and SLR mandatory requirements as stipulated by the Central Bank of India, that is Reserve Bank of India. And their also aim is to meet the sudden demand of funds which is arising out on large outflows. Guys, that is why the last one I'll be telling you about the same thing, and that will be that it has to ensure that the following purpose is being achieved, because call money usually serves the role of equilibrating the short-term liquidity position in the banks. So that's how it basically develops the core features of the money market to meet the SLR and CRR mandatory requirements which is being stipulated by the Reserve Bank of India, to meet the sudden demands for funds arising out of large cash flows. And hence, the call money usually serves as the role of equilibrating the short-term liquidity positions of the banks. And that's how it works. Now let's move to our next topic, and that is Treasury bills, T-bills. So guys, I would call T-bills and Treasury bills as a very important topic for the CA final preparation, but I would call it as a topic which is being used in our daily terminology in the financial markets. So it is basically a kind of a thing which is being introduced in the money market segment by the government of India, and usually all our questions which are rather being involved in bond valuation, or we can take up mutual funds. So many of the times I have actually told you about this T-bill rate. So usually it's 90 days T-bill rate. So what is Treasury bill? What does it work upon, and how it is actually having the basic features in order to ensure that T-bill which is being introduced by the government of India is properly moving with the demand and supply forces in the correct way as a money market instrument. So we'll discuss about it in this presentation. So what is a Treasury bill rate and how it is actually work? So a Treasury bills are usually the class of central government securities. So I have already mentioned this to you in many of my past presentations that it is being issued by the government of India. So that's the way it is being taken care of, and hence it is a very risk-free investment. So T-bills are issued by government of India against their short-term borrowing requirements with maturities ranging between 14 to 364 days. The time period in this case will be involved as 14 days to 364 days. T-bills currently are issued by Government of India or Reserve Bank of India in the primary market, which are 91-day T-bill rate or 365 days T-bill. So these are the current lot which is being available in the market. So if in case you guys are pretty much interested in investing in this particular segment, then you can go in for 91 day or 364 day T-bills. Better, my advice will be like in that case, you should start investing with a 91 day T-bill rate, because that is likely to ensure your liquidity requirements being met on time as well. So you don't need to wait for like 364 days. You can simply go for a 91 days option, and whenever you wish to, you can purchase it and sell it on the same time, and that will be like maturing after a period of 91 days. So you don't have to wait for its maturing period for like 364 days. So that's a better option. T-bills are issued at a discount to face value. So guys, this question was also dealt in my past presentations, wherein I referred to cases for bond valuation itself. So there also we did talk about these cases. Discount to face value basically means that, okay, I'll start investing in a T-bill which is presently available in the market for like rupees 690 or say like 700, and it is going to mature at 1000 rupees. So I am currently supposed to pay out 700 rupees, and after a period of like 91 days or 364 days, I'll be able to extract 1000 rupees from the market for that particular issue. So that's how T-bills are usually issued. So they are issued at a discount to face value. Though it's just an example which I have just mentioned to you, 700 to 1000, that's actually not going to happen, because that's an extreme case, and the interest amount is extremely high in such cases. But certainly it would be like, okay, you'll start investing by like 900, 950, and you'll be able to achieve a maturity amount of rupees 1000 by the end of the maturity period term. So that's how it works. Banks, primary dealers, state government, provident funds, financial institutions, insurance companies, NBFCs, foreign institutional investors, NRIs and OCBs can usually invest in Treasury bills. So n number of people are available who are actually willing and who are capable of investing in the Treasury bills. And the last one, 91 day T-bills are auctioned under uniform price auction method, whereas 364 day T-bills are auctioned on the basis of multiple price auction method. Now you guys must be pondering, and I know that. So what does this auction actually mean? Okay, Manoj Papani just said, okay, 91 day T-bill rate are auctioned under uniform price auction method, whereas 364 days T-bill are auctioned under the basis of multiple price auction method. But sir, please tell us, what is auction mean? What does auction actually means? So guys, auction is a process of calling of the bids with an objective of arriving at the market price. So it is basically a price discovery mechanism. There are several variants auction. Auction can be price based or yield based. That can be both the possibilities around. In securities market, we come across various methods. Like if I'll have to tell you something more detailed to it. So there is one French auction system which is available in the market. There is another Dutch auction method which is available in the market. So let's not get like too deep in that. So hence the presentation will go a bit long. But still, in order to make you understand about French auction system, I can simply say it is like after receiving the various levels of yield expectations, a particular yield level is decided as the coupon rate. Auction participants who bid at the yield levels lower than the yield, which is determined as cutoff, usually get the full allotment at the premium. The premium amount is equivalent to price equated differential of the bond yield, and thus that is called the cutoff yield. Applications of the bidder who usually bid at the levels higher than the cutoff level are like outright rejected. Okay, they will be the guys who won't be allotted the securities in such cases, and this is usually called the like French auction system. If I'll have to tell you something with that example, which I have just reiterated in the back of my slide. So like if you are willing to invest like 700 rupees for the sake of maturity amount of like 1000. So if in case they have made up a benchmark of like 700. So all those investors who will be willing to pay currently for like more than 700 for the sake of like 1000, they'll be like accepted. And the ones who will be like depositing or investing like less than 700 will be like outright rejected in that case. So that is how French auction system works. And in case of Dutch auction system, that is like a case which is absolutely similar to French auction system. The only difference being that the concept of premium doesn't exist over here. So that means if all the successful bidders get a cutoff price of like let's say 100 or let's say 1000, so they do not need to pay any kind of premium irrespective of the yield level bid whatever they wish out for. So that is how actually it works upon. So guys, this is how the entire auction process works. So I hope so that I was able to deliver you the perfect kind of clarity as to what Treasury bills usually mean. They are the securities which are being issued by the central government of India or RBI in the primary market. The current issue which is being available in the market is for like 91 days and 364-day T-bill rate. These are issued at discount to face value. Banks, primary dealers, state government, provident funds, FYs, insurance companies, NBFCs, they are the persons who can invest in the T-bill rate. So that's how it actually works upon. So now let's move to our next topic of the day, and that will be Interbank Participation Certificates, IBPC. So guys, this question was asked in CA Final Examination for May 2012. So let's understand what does Interbank Participation Certificates actually mean. So IBPC are the short-term instruments that provides banks to manage their short-term credit portfolio and even out the short-term liquidity within the banking system. So this is a particular instrument which is being issued by the banks in order to ensure that the kind of liquidity position they are having within their banking system, that is like correctly managed or not. So let's say if today the banks are in some liquidity crunch and they need to pay, and certainly, so what's the kind of best options they are currently having in their hand? They can directly contact RBI. Okay, that is one case, right? But what if about some other alternatives? So here comes interbank participation certificates in the picture. So wherein they are able to they can issue these participation certificates. On behalf of those, they'll be able to take care of their liquidity position on time, and they'll be able to clear off their dues, whichever are the same required to be paid to other people. So that's how it actually works. IBPC is a tool confined to only scheduled commercial banks. So you and me cannot issue any kind of interbank participation certificate. So it is only the scheduled commercial banks who are entitled to issue these kind of IBPC basically. IBPC can be issued by scheduled commercial bank and can be subscribed to by any commercial bank. So is usually issued by a scheduled commercial bank and that can be subscribed by a commercial bank. So okay, that's a kind of dealing which is being taken care of on B2B level. So that doesn't go for any kind of B2C. So a bank can go for another bank over here. The participation can be issued in two types, that is with or without risk to the lender. So now what does this risk perspective actually means? Let's dig down in order to extract something more to it, and let's understand the similarities which is being involved in interbank participation certificates so as to get the best kind of concept clarity in this case. So IBPC without risk sharing, this is a kind of thing which can be used to even out the short-term liquidity. So IBPC is issued in against of any kind of underlying advance, and the participation is usually backed by the outstanding amount of the cash credit accounts of the borrowers. The tenure in such case of participation cannot exceed 90 days. That has to be remembered, guys. In such cases, the rate of interest for the participants would be left free in order to be determined between the issuing bank and the participating bank, subject to a ceiling of 12.5%. That is the kind of ceiling which has been mentioned by RBI in such cases. And the issuing bank will show the amount of participations as the borrowing, and while the participating bank will show the same under advances to bank in their respective balance sheets. The issuing bank will normally repay the amount of participations together with the interest to the participating bank on the date of maturity, except when the risk has materialized. In cases where the risk has materialized, the issuing bank will take the necessary action in consultation with the primary participating bank and share the recoveries proportionally in such case. So that is how IBPC without risk sharing actually goes for. Whereas in case of IBPC with risk sharing, this helps a commercial bank to manage its capital adequacy as well as meeting the shortfall in priority sector lending. So guys, IBPC with risk can be issued for a period ranging from 91 days to a maximum period of 180 days. The rate of interest on participations would be left free to be determined by the issuing bank and participating bank. subject to a minimum of 14% per annum in such case, because this is with risk sharing, whereas in case of without risk sharing, that was a maximum of 12.5%. This scheme is basically beneficial to both issuing as well as the participating bank. The issuing bank can secure its fund against the advances without actually diluting its asset mix. So that's the kind of benefit they are having. In the case of issuing bank, the aggregate amount of participations will be reduced from aggregated advances outstanding. And such transactions will certainly not be reflected in the individual borrower's account, but will only be netted out in its general ledger. So that's how it goes on. So that was all about interbank participation certificates. So guys, this question was asked in C final examination for May 2012. I do believe that you guys got the entire clarity, and I did share enormous amount of glances relating to this particular topic, though so much will not be needed. You just have to remember these 6 major points which I have mentioned in my presentation slides. So that will be more than sufficient to score the complete 4 out of 4 marks for C final purpose. But however, I wanted to deliver you the maximum kind of knowledge so that can help you in your near future as well, because I am basically making you understand the financial literacy not just for the sake of examination perspective, but also to enable you for becoming a successful financial manager across your life in your altogether life. So the last topic for the presentation would be certificate of deposits. So what does certificate of deposit basically means? Let's head to it and let's understand. So guys, certificate of deposits is basically a negotiable money market instrument which is issued in demat form or as a usance promissory note against funds deposited at a bank or other eligible financial institution for a specified period of time. A certificate of deposit can be issued by scheduled commercial banks or selected all India financial institutions that have been permitted by the Reserve Bank of India to raise short-term resources within the umbrella limit which is being fixed by Reserve Bank of India. Certificate of deposits are the negotiable term deposit certificates which is being issued at discount to face value at market rates. So guys, that is the maturity date for the complete certificate of deposits in such cases. So the maturity period for certificate of deposits issued by the bank should not be less than 7 days and not more than 1 year from the date of issue. The maximum period is 1 year, the minimum period is 7 days. The financial institutions can issue certificate of deposits for a period not less than 1 year and not exceeding 3 years from the date of issue. So that's the basic difference between a bank and a financial institution. So by bank, the minimum limit is 7 days, whereas in case of financial institutions other than banks, that is a minimum limit of 1 year. However, the maximum would be for banks it is 1 year, and for other financial institutions apart from banks that is 3 years. Certificate of deposits are issued by banks when the deposit rate of growth is sluggish and the credit demand is high and a tightening trend in the call rate is pretty evident. So let's understand the mentality and let's understand the behavior of banks as to why they want to issue a certificate of deposit in the market. So guys, just think about a situation as to why a bank would issue a certificate of deposit in the market. So the only reason behind the same would be that if tomorrow people like you and me are not depositing their amounts, their funds in the banks, then certainly in such cases the deposits will be pretty low in the banks. However, if in such cases the credit demand is extremely high in the market, as to people are willing to accept funds from the banks. However, the banks are actually not having the funds in their accounts. So what they'll do, they can simply issue a certificate of deposit. There are people like me and you who will be directly investing in those certificate of deposits, wherein the banks will be able to extract some amount of good returns, and certainly they'll be able to cater to the credit demand requests which are being made by various persons in our nation, and wherein such credit demand is high and certainly a tightening kind of trend is available in the call rate. So that's where certificate of deposits are basically issued by the banks and financial institutions, where the deposit growth is actually sluggish and the credit demands are high and the call rate is pretty tight and evident, which is available in the market. Certificate of deposits are generally considered high cost liabilities and bank have to recourse to them only under tight liquidity conditions. So that has to be understood. Like, okay, let's suppose today I am already having many of the funds in my hands. So why would I go for any kind of other option? Certainly not. Okay. So same case is available with the banks as well. If banks are having good amount of liquidity, banks are having good amount of funds in their accounts as public deposits or like any kind of private equity deposits. So certainly in such cases, the bank is not willing or won't go for any kind of option to issue a certificate of deposit. It is only when there is a dearth of money, and certainly the banks are into like much kind of problem as far as the liquidity is concerned. That is the time wherein they invest and they issue certificate of deposits to the general public. So certificate of deposits are generally in such cases considered as a high cost liabilities, and the banks have to like recourse them only into such tight liquidity conditions. So that's how it works. So that was all about certificate of deposits, as to what is certificate of deposit, what is the maximum duration and minimum duration with the maturity period that it can be issued for banks and financial institutions, and when are the same being issued in the market. So I have already told you about all these aspects relating to certificate of deposit, and I do believe that you guys got the complete clarity as to what a certificate of deposit actually mean. So let's head to our last topic for this presentation, and that will be features of certificate of deposits. The first feature would be that certificate of deposits would be issued at a discount to face value, and the discount rate is market determined. So demand and supply forces usually allow a bank to frame that discount rate, which is why to be presented to the investors in such cases. So bank CDs are always discounted bills, whereas CDs of financial institutions can be a coupon bearing as well. So that has to be taken care of. If I'll have to like state a comparison between the two, the bank CDs will always be a discounted bill. Okay, so if the maturity amount is 1000, I'll be issuing certificate of deposit at say rupees 900. Okay, so that will be position of discounted bill. Whereas in case of financial institutions, there might be a possibility that they'll be issuing on complete 1000 only, which is equivalent to the maturity amount. However, in such case, they'll be providing some coupon rate over that. So they'll be providing some like 5% or let's say 10% kind of rate of interest on annual basis. That's the difference between a bank CD and a financial institution CD. Next comes, banks have to maintain an appropriate reserve requirements, which has to be maintained. So like a cash reserve ratio, the statutory liquidity ratio on the issue price of the CDs, it has to be maintained at all times. So it's a kind of norm which is required to be made and fulfilled all during the times which is being mentioned by RBI. Apart from that, CDs are freely transferable by endorsement or delivery. But remember guys, that can happen only within the next 15 days of the date of issue. So if tomorrow like a person is willing to invest certificate of deposits, so it has to ensure that they have actually made up their mind to invest in that. If let's say they want to transfer the same by endorsement or delivery to any other person, so they'll have to ensure that they transfer that within the next 15 days of the date of issue. That has to be taken care of. Banks are not allowed to grant loans against certificate of deposits nor buy back their own certificate of deposits. So that's a kind of condition which is being imposed by the regulatory authority over them, and that is the Reserve Bank of India. Apart from that, the minimum issue size of a certificate of deposit is rupees 1 lakh. And almost all the banks are for an initial maturity of 15 days. Whereas in case of financial institutions, they can issue certificate of deposits with an initial maturity of 1 to let's say 3 years. Apart from that, there is no cap on the amount that can be raised. Okay, so minimum issue size has to be like 1 lakh, and the maximum would be like anything. Guys, there is no cap on the amount that can be raised. The maximum amount is actually not available, that can be taken care of by the person who is issuing. Certificate of deposits are issued by the bank subject to the stamp duty. So that's the guideline. Apart from that, certificate of deposit can be issued to individuals, corporations, and companies. That's the added advantage. So you, me, any kind of company, any kind of corporation, we all can invest in certificate of deposits. So that is not the kind of thing which is likely to be like made available just to the scheduled banks or corporations or companies. So even guys like you and me can even take the benefit of investing into certificate of deposits. So that was all about this presentation, guys. I hope you guys got the complete clarity as to what all these money market instruments actually mean, and I'm sure that you guys are honoring your word time and again. Do revise all the topics, guys. I would love to see your results like touching skies in such manner, and certainly I'll be like most happiest kind of guy who will be available on this planet Earth if in case my students really rock at the CA final examinations. So for rocking the CA final examinations, you will have to ensure that you revise your topics time and again. So please adhere to those guidelines. I'll be concluding my presentation with a dose of motivation, and that would be you can cross the sea. You can't cross basically, so you cannot cross a sea merely by standing and staring at the water. If in case you have to cross the sea, definitely you will have to take up the courage and you will have to take up the action of not just standing and staring at the water. You'll have to start swim in order to achieve your goals, in order to reach to your destination. You'll have to move out of your comfort zone. Then only you will be able to achieve that. Rabindranath Tagore mentioned this quote, and I felt I have to introduce this in my dose of motivation. So guys, cheer up, take actions time and again, keep failing. I will actually say that, keep failing, because if you're failing in day out, definitely that day is not far when you'll be able to achieve your success with time, and certainly that is going to happen one day. So keep failing, and then one day you'll be able to succeed. Thank you on behalf of the IDPedia world. Keep interacting, guys, via your comments, queries, and questions in the YouTube message boxes which is being available. Stay connected. That's the only way we'll be able to understand your needs way better. And yes, that's the time I'd like to say a goodbye to you guys. Love you. Take care. Bye.